Let's go ahead and do a quick presentation on computing lease payments. Now, if you have an asset with a fair value of $100 and you wish to dispose of it, you're going to insist that the present value of what you receive for it is equal to at least $100. Now, obviously, one alternative is to sell it for $100 cash. Now, assume that a potential buyer wants to buy the asset but wants to pay for it later. Are you willing to do this? Well, as long as you can charge interest on the deferred payment, then you'd be okay with that. Essentially, a lease involves deferred or future payments for the use of an asset. The lessor, rather than selling the asset for cash, is willing to enter into this arrangement because they expect to earn interest on the deferred payments. The interest rate which the lessor wants to earn on the lease payments is sometimes referred to as the lessor's implicit rate. Now again, the idea is that the present value of everything the lessor expects to receive must equal at least the fair value of the asset. Now we're going to operate under the assumption that the lessor is the price setter and the lessee is the price taker. In reality, of course, the lease payments are negotiated between the lessor and the lessee. Now, what sort of cash flows or value flows does the lessor expect to receive? Well, there might be some upfront payments. If you look at the advertisement for car leases, most of them in the fine print say $2,000 due at signing or something to that effect. Sometimes referred to as a capital cost reduction payment. Textbooks in financial accounting generally ignore the upfront payments, but in reality, of course, they exist. There are going to be the periodic rental payments, and there's going to be some sort of terminal cash flow or value flow, whether it's a terminal cash payment from the lessee to the lessor, or whether it's the value of the asset upon return. Now, if the asset is returned, it's expected to have some positive value when it's returned. That's referred to as the residual value. This residual value can be either guaranteed or unguaranteed. If the residual value is guaranteed, that means that the lessee can be held liable for it. So if there's a $100 guaranteed residual value and the asset is returned and it's not worth $100, the lessee is forced to write a check to make up the shortfall. If the residual value is not guaranteed, or if it's unguaranteed, that means the lessee can't be held liable for it. Either way, from the lessor's perspective, this is an expected inflow of value. Whether it's guaranteed or not, the lessor expects to get something at the end worth some specified amount of money. Alternatively, there may be a bargain purchase option price. Let's say, for example, that you go out and you lease a brand new car. You lease a 2019 Honda Accord, and you lease it for 3 years, and the lease says at the end of 3 years, lessee can buy the car for $1. Now, clearly that would be a bargain purchase, and you, the lessee, would be expected to exercise it, and so the lessor would expect to receive $1. At the other extreme, let's say that, again, this is a $30,000 car, and at the end of 3 years you have the option to buy it for $25,000. Is that going to be a bargain purchase? Well, probably not. So there's some sort of vague line where the purchase option price is or is not a bargain, but basically the idea behind a bargain purchase option price is the lessee is given the option to buy the asset at the end of the lease, and the option price is expected to be such that the lessee is expected to exercise it. It is a bargain, and we assume it will be exercised. So what we have is the fair value of the asset is going to, again, be equal to the present value of everything the lessor expects to receive, which is the present value of any upfront payments, plus the present value of the rental payments, plus the present value of any terminal payments. So let's go ahead and go through an example, assuming that lessor company has an asset with a fair value of $1,000, and they want to lease it out for 5 years with the payments at the end of each period. There will be a $200 upfront payment, and the asset is expected to be worth $100 when it is returned. Assuming the lessor wants to earn 10% on their lease investment, what will be the amount of the annual rental payment? So again, the fair value of the asset equals the present value of the upfront payment plus the present value of the rental payments plus the present value of the terminal payment. The upfront payment, the present value, is simply the $200. The rental payments are what we're looking for, and the present value of that terminal payment is $62.09. Again, that's $100 discounted at 10% for 5 years. So the present value of the rental payments is $737.91, and since this is a 5-period ordinary annuity at 10%, that implies a rental payment of $194.66. Again, this just summarizes what we just went through. Now, let's say that the lessee wants a lower annual payment. Now, looking at that, that formula up at the top of the sheet, that horizontal equation, we basically have 4 items. We have the value of the asset, we have the present value of the upfront payment, we have the present value of the rental payments, and we have the present value of the terminal payments. So we have 3 things that have to add up to $1,000. If you want to make one smaller, the other ones have to get larger. So let's see how we can get a lower annual payment. We can either reduce the interest rate, we can increase the upfront payment, or we can increase the terminal payment. Let's assume the lessee wants to pay $150 per year. What sort of upfront payment will be required, assuming all other information remains the same? Again, we have the same horizontal equation as before. Now we simply have a different item being the unknown that we're solving for. The fair value of the asset equals the present value of the upfront payment plus the present value of those $150 rental payments plus the present value of that terminal payment. So the present value of the upfront payment must be $369.39. So if the lessee makes an upfront payment of $369.39, they can get away with a $150 annual rental payment. Now, in textbooks, the horizontal equation format we've used is turned 90 degrees. So basically, we're going to have the fair value of the asset minus the present value of any upfront payment minus the present value of any terminal payment equals the present value of the rental payments. We then determine the rental payments that have the indicated present value. Let's go ahead and go through one more example. Let's assume we have an asset with a fair value of $10,000. There will be no upfront payment, but there will be a $500 unguaranteed residual value. Now again, from the lessor's perspective, whether the residual is guaranteed or not is irrelevant as far as this step is concerned. That's $500 the lessor expects to receive. So it's going to be included. The asset will be leased out for 10 years with payments at the beginning of each period, which means this is going to be an annuity due basis. And again, let's assume the lessor wants to earn 10% on the receivable. We start with the fair value of the asset, $10,000. Subtract the present value of that $500 residual value, $192.77, and that gives us the present value of the rental payments, $9,807.23. Again, a 10-year, 10% annuity due means annual rental payments will be $1,450.98.